Hey everybody, it's Eddie from Tokyo. This is your cryptocurrency update from Japan, and I've got a really good video for you. This is a high-level BIS panel. That's the Bank of International Settlements. Why do you want to watch this? Well, everybody is rushing to a CBDC. That's a central bank digital currency. And do you think they're as private as cash?
Is it going to be as private as cash? No. So a digital currency will never be as anonymous and as protecting of privacy in many respects as cash.
Also, programmability. Well, the conditions of use for a specific purpose. The Monetary Authority of Singapore is going to weigh in on that. And what about settlement? Well, you're going to hear that atomic settlement is the flavor of the day. And how will they handle liquidity? Well, it looks like through tokenization of deposits. Yeah, tokenization can come all the way from cows to money. You're going to hear from the Bank of Korea. All right, everybody, let's go.
The public is particularly concerned about privacy. All the surveys that we've conducted, the client focus group, the reaching out exercises that we've conducted have all said the same thing. People are concerned about their privacy, and there is that, anxiety of a big brother central bank having access to data. And I think that's not a very well-grounded concern. And I'll try to explain to you why. A central bank has zero interest in using the personal data of the clients of the banks, because as François indicated, the banks will be the natural intermediaries that will actually be operating what is legally required in terms of anti-money laundering, countering the financing of terrorism, and know your customer regulatory requirements. The central bank is not going to do that. So the central bank is not interested in data. The central bank does not want to monetize data. On the other hand, some of the big tech companies that are considering venturing in the field of stable coins in particular have a great interest in using, collecting, handling, and analyzing data on a grand scale and monetizing it. So I think the anxiety is misplaced in relation to a central bank, and should be more concerned about what use is made of personal data and information by some of those large tech companies.
That today, cash and notes and coins can't do. And that's programmability, because when this cash gets transmitted through the system, it can't be programmed. But the retail CBDC that a central bank issues, as it goes through the system, it can be programmed. Because you are expressing money in token form, the ownership rights are expressed in digital form, in form of a program. And so you can write into the program conditions for its use. Once that conditions are met and the money is discharged, it goes back to its original form. So it is basically the ability to write a computer software program on money to move it around for a specific purpose. And after that, it ceases, and then it can be written by others who use that money. So the way I look at programmability is that it is an option that can be built into digital currencies that make them useful. So we need to be clear in our minds, what is it that CBDCs do that currently cash can't do? And one is programmability, mostly I would think for domestic purposes. The other is atomic settlement for cross-border payments. Because today cross-border payments is not great shape. It's not in great shape. And I think collectively
What is atomic settlement, I want to know?
Atomic settlement is where you can exchange two assets in real time, and settlement is instantaneous.
It's bundling.
Right?
Bundling of transactions.
Bundling of transactions. Okay. And that's why I said cash, if I owe you 10 euros and I give you 10 euros, I've not only paid you, I've also settled. Whereas if I send it through the banking system, your bank and my bank has not settled. I've paid you, but the bank has not settled. This is a huge problem. It is inefficient, it is archaic actually in the modern age of the internet, that our banking system works like this, where settlement is not instantaneous. And you can imagine the cost. There's daylight settlement risk that all banks face. They have to put aside collateral in case settlement doesn't happen. The delay of 3 days or 2 days is an additional friction in the system. CBDCs can help to solve that, because with CBDCs, it is equivalent to cash being exchanged, euros for dollars being exchanged instantaneously. And that can be done on multi-CBDC platforms. And the BIS Innovation Hub is doing great work in the Swiss Center, the Hong Kong Center, and the Singapore Center. And many others are doing the same thing. And I think governments will probably use it for purpose-bound money when they want to give money to lower income groups to buy daily essentials and necessities. That can be programmed. You can actually program payments along a supply chain. If you write, a program is basically a smart contract. And so today, again, like cross-border payments, our trade finance and trade logistics is hugely inefficient. Lots of documentation, lots of reconciliation, lots of duplication work, because nobody has a common ledger. A distributed ledger means everybody operates on a single ledger, and when conditions are met, documentation is filed, payment is automatic and seamless. So these are possibilities. It looks a little science fiction because there are huge problems you need to overcome to get to that stage. But many smart people, both in the public and private sectors, are working very feverishly. And as Francois said, the central banks are getting into this, because unless we dirty our hands, we're not going to understand the intricacies involved here. Mm-hmm. So the key is whether this can be scaled. So I think these are the two real killer apps, if you will: programmability and atomic settlement. One is cross-border, programmability is domestic, and that's not the central bank's role. We are just making that option available, that here I used to give you paper money, now I'm giving you in token form the same cash, but with this feature that you can build on. So cash in physical form settles instantaneously, right? When you pay, the payment and settlement is in one transaction. But when you send it through a digital channel, settlement is not instantaneous. And this is where, as Christine said, what you need is digital cash to combine the benefits of digital and the benefits of cash. And that is what digital currencies do. So I think this second monetary system that will coexist alongside the first monetary system will have that feature. And I think it's important from the security and resilience point of view, that monetary system must mirror the structure of the traditional monetary system. Two-tier system with central bank money as the core of the system, the foundation, and commercial bank money, the bulk. So I think the components there will be CBDCs as providing the foundation, the counterpart to notes and coins and central bank reserves. And we know today that private money to public money ratio is like 10:1. Most of the money we hold is private. So I think in future, CBDCs will be that base. And I think the second major form of money will be tokenized deposits, where the deposits that we have with our banks today, we can choose to tokenize a part of it, meaning we express that deposit in digital form, where our ownership rights are embedded together in the form of a token, and it can be transacted on a blockchain or distributed ledger. And that opens up possibilities to do many things that today we can't do. So I think you'll have a layer of CBDCs, a layer of tokenized deposits, possibly, and this is something, there's a lot of debate about, whether a third layer will be non-bank stable coins. And today, liquidity risk is a huge problem for all of us, and we're still facing it, right? Mm. And to look for a counterparty for liquidity. And with automated market making, you are actually trading against a pool. And this can potentially, and this has been piloted and is successful. The question is, can we scale it? And to scale it, you need a framework of trust, of who you can bring into the system. And you can, alongside solving the settlement risk problem, considerably address the liquidity risk problem. So the possibilities are boundless, and I think we need to continually innovate and experiment and learn from failure, because there have been many things that didn't work, and really evolve towards building a much better monetary system that's fit for the 21st century.
I think we need tokenized deposit because the tokenization of assets are well on the way already. For example, in Korea, we have a security token offerings already, and many non-structural assets such as music, properties, and even Korean beef are tokenized. For example, like a company called Bancow is selling tokens, ownership of this calf they have purchased is breeding, and then with the sales revenue to be distributed to the token holders once the calf is grown up and sold. So there are many tokenization assets going on. So in some sense, in order to make, with this given high demand of asset, tokenized asset, it's natural to think about how we develop tokenization of the the money side. So we decide in our pilot, we actually have done a 2 years pilots previous time, and our conclusion is that Korea is who has a well-advanced fast payment system. Probably the benefit of having a retail CBDC is quite limited. One exception can be the programmability of the money that Ravi just mentioned, but our conclusion is that even that same benefit can be realized and achieved using only the wholesale CBDC. So what we decide is together with the BIS, we will set up the infrastructure where the tokenized deposit can be issued and exchanged with the wholesale CBDC. And that has many merits that Ravi mentioned. It will maintain the two-tier monetary system intact, and while allowing the flexibility of the bank to address the different demand from the clients by exploiting the programmability function of the tokenized deposit. So that's where we actually heading for.